Hi everybody, welcome to this team training session regarding workplace pensions. We hope you found this session really interesting. Before we start, who are we? I'm a pension specialist from DH Financial Planning. We're based in Warrington. There's 60 advisors. We're here to help you understand the myriad of issues around pensions, but we also look after all your financial planning needs. During this session, we're going to talk to you about what auto-enrolment is. I'll talk to you about why it's happening, how it's going to affect you, how you join, and who's actually behind your pension scheme, so who's managing your money. So, does it affect you? So if you're sitting watching this video today thinking, well, it doesn't affect me, these are the 3 parameters that you have to be set by. So you only enroll into a workplace pension scheme if you are currently 22 years old and under state pension age, which now in 2017 is age 65, but it will get older over the next 10 years. You've also got to be earning £10,000 a year, and you have to be working in the UK. This workplace pension legislation is all about UK workers over 22, under 65 and earning £10,000 a year. So what's the legislation all around? It's to try and get people working in the UK to try and save for their retirement. You're going to have to put some money away now for when you get older, because most of us will be living longer, well into our 80s. You work for somebody, you work for the company where you're watching this video currently, and you're going to be auto-enrolled when the company tell you that that's going to happen. So why is it happening? On the slide you're going to see here now, you can see that if I was a man born in 1960, on average I'll live to age 68. However, if I was born in 2012, my average age at which I will die is 82. That's gone up a massive 17% over that period of time. And likewise for women, women are now likely to live well into their mid-80s. But then if you look at what the state pension is currently paying you, if you've paid into the state pension through your national insurance contributions, you have to be paying into that pot for a minimum of 35 years to get the full state pension. And the full state pension currently today in 2017 is £8,093 or £155.65 per week. So not many people can actually live off £8,000 a year. So let's have a look at what you pay in and what your employer pays in. And it's quite simple now. On the chart on the left hand side of me, you can see that your company pays in 1% of your salary and you'll pay in 0.8% of your current salary. That makes up 2% when you've added in what the taxman gives you as well. Well then, as we fast forward to April the 6th, 2019, those contributions have gone up. Your employer will be paying in 3% of your salary. You'll be paying in 4% and you'll also get 1% back from the taxman. So a total of 8% of what you're earning at the moment will be getting put automatically into your saving pot for retirement. Your employer has decided to choose what's called a banded earnings pension scheme. At the moment, the first £5,824 of money that you earn every year, you won't pay any pension contributions on that amount, and nor will your employer. So it'll only be the bit above that, and if you're fortunate enough to be a high rate taxpayer, then the top level is capped at £42,385. So you and your company only pay pension contributions on that band in the middle. So you've got a banded earnings scheme. So we get asked a lot of the times, well, why should I opt into this? Why don't I just opt out? I can't afford it. I'm really struggling at the moment anyway. And I can't really afford to save for later on. I'll do that when I get into my 30s and 40s. All I can say to you is that the people that started saving in their 20s now have a comfortable retirement because they started saving small amounts early on. The people that have left it till the 30s and 40s and 50s have left it a little bit too late. And an example that's just appeared on the screen is that if I was age 30 now and I'm going to work until 65, at which time I say, I've had enough, I'm cashing in my chips, I don't want to work anymore, I want to take my retirement income now from the 35 years of saving. Your employer during that time will have paid in enough money for that to be worth around £25,000 with the growth that you're going to get on those pension savings over that 35 year. So if you're thinking about should I join or not, really you're thinking about am I willing to give up £25,000 worth of free money? So we get asked quite a lot during these presentations about, well, I don't really know how much I'm going to need when I get older. How much should I save every month and what will I get? What's the point of me putting any of my money in because I'm probably not going to get anything out at the end? There's a couple of examples coming up on the screen for you now, and they're both based on me being a 35-year-old person and I'm going to work until I'm 65. I'm going to need £14,000 a year when I'm 65. So in today's money, I need £14,000 a year to live off. I'm going to expect that I'm going to get a full state pension because I'm going to be paying into national insurance for the next 35 years. So already in the pot towards the 14,000, I'm going to have in today's figures £8,093. So I only really need another £6,000 or so. If I was to pay in £50 a month and my pension scheme grew at 2.4% a year, my pot will be worth approximately £28,000, which isn't going to last me very long. On that basis, you're going to last you to just over 70. So that's probably not what you're going to be saving each month. If we take the same person, retiring at the same age, with the same income needs and full state pension at 65, and my pot's now growing at 5.3% per annum, and I'm going to put in £200 a month into my pension pot, that pension pot's going to be worth £226,000 in today's money. That will last me approximately to just over age 100, so I'm probably going to have enough. Now, that's not for me to tell you what you need to save each month, that's just for me to give you an example of how much you could save and what it's potentially going to be worth. Those annual returns you get on your investments are totally dependent on how well the stock markets do, because your money is going to be invested in the stock market, and we'll come on to who's doing that for you shortly. Once you get to retirement, let's say it's worth £200,000. Currently, under legislation at the moment, you can take £50,000 out of that as a lump sum, tax-free, no issue. The other £150,000 can come out straight away, but you'll pay tax on all of that at the rates of 20%, 40%, 60%, depending on how much money you're taking out in that tax year. So that income's taxable. So you want to make sure that you're managing it when at retirement so that you can take it out as tax efficiently as you can. And here at DH Business Support, that's something that we can help you with. What happens if I die then before I actually get to my retirement age, before I can actually take this money out? Just imagine at this stage, it's just like a bank account for you. So you've got a Barclays bank account, it's sitting there and you passed away. Basically, if you've got a valid and up-to-date will that says, I leave my assets to my mum, my dad, my spouse, my civil partner, my children, then they will get your pension pot. And depending on their circumstances at the time of your death, they'll either get it tax-free or they'll get it taxed as income. And you can also get to use a nomination form to make sure that, God forbid, something did happen to you, then somebody in your family benefits from your savings. So, can you join the scheme later? We get asked this question quite a lot. So, you're automatically enrolled. Let's say, for example, in your case, your scheme starts this December. You'll automatically be enrolled in your December pay, so your pension contribution will come out in December. But if you opt out of the scheme, you'll get your money back in January. Your company has no obligation to re-enroll you back into the pension scheme for a further 3 years. And the government have set a 3-year window for you to be automatically put back into the pension scheme. You can opt out again if you want, but the company that you work for will have to automatically enroll you back in 3 years' time from now. What happens if I don't qualify? So I'm not 22, or I'm over 65, or I don't currently earn £10,000 a year? Great question. It all depends how much your earnings are and what age you are, whether you can join the scheme and whether your company will pay for you or not, or whether you can join the scheme and just make contributions yourself. What if you've been a member of a pension scheme somewhere else? So you've got old pension schemes, or maybe you've worked for the government or the council and you've kind of lost track of it. What can you do with those? Well, you've got 3 choices really. You can leave them where they are because they might be a great scheme. You can transfer them in free of charge by just filling in a form and transfer them into your new workplace pension. Or you may want to do the third thing, which is 95% of our clients do, is just take independent advice. At that stage then, a member of our team will be looking at your pension contract and telling you whether you should move it or you shouldn't, and whether you should put it in your workplace scheme or not. How will you know how much state pension you're entitled to? That's quite simple. On the screen now you can see Google, so log on to Google and just simply type in BR19, click go, and a form will come up from the government. Print it off, fill it in and send it off, and in about 3 weeks' time they'll send you what's called a state pension forecast back. So at that stage, you'll know you'll have a date in time when you're due to retire, and it'll give you an estimate in today's figures of how much per week you're going to earn from state pension. If it doesn't look quite right, if you think I've worked more years than that, then you can just give them a quick call and they'll go through it for you. So who are the two people then that actually run the scheme? So the first company are a huge American organisation, and in the UK they trade as Amber Financial Investments. They're the people that are regulated by the Financial Conduct Authority, and they're the ones that we can choose to who we invest your money with. So they're fully regulated and fully backed, and they're organised by the pension regulator as well. The people that are actually going to manage your money are the biggest fund manager in the world. They're a company called Blackrock. They currently manage $1.7 trillion of pensions and savings money across the globe. They also run pension schemes for states in America. So Amber themselves, once you join the scheme, you'll get a welcome pack letter and you'll get a login to your own portal so you can see what's happening with your pension. You can go on there, you can check your statements, and you can also check how much is your pension worth this year. So why as a company did we choose Blackrock to manage your pension scheme? It's really, really simple. Look at the screen next to me now of some of the huge companies in the UK that have got Blackrock looking after their pension. Nike, Adidas, Rank Xerox. So hundreds of thousands of employees across the UK currently have the same pension being managed by Blackrock as you will have as well. And here's a really confusing slide, but basically what this means is this Blackrock fund that you go into initially, it works out on average that you're going to retire at age 65. Whilst you're younger, it's going to invest in stocks and shares. But as you get older, it wants to take less and less risks. So as you get older, you can see the colours on the chart changing from blue to dark blue to orange to green. What does that mean? It basically means that you're going to have less stocks and shares in your pension pot as you get older, and it's going to turn to more things like fixed income, things that aren't volatile in the stock market. And as you get into the final year, it's going to move all your pension savings into cash. Now, it's really important that you understand why they do that. It's really simple. If you go back to mid-2008, if you were fortunate enough to have £100,000 in your pension pot, a lot of people lost £50,000 in that pot overnight because the stock markets crashed. That can't happen to you with a Blackrock default fund that we've got in your pension, because as you get towards your retirement age, it's going to switch to more cash. So it doesn't matter what happens to the stock market, your investments, your pension savings are going to be less risky at that stage. My recommendation would be that you just leave it alone, you just leave Blackrock to do the job. They're managing your money every single day of the week, Monday to Friday, 52 weeks of the year. So what's the future going to look like then? What's happening with pensions, and what are the government playing around with that you need to be aware of? Well, the first thing is that currently, today in 2017, you can take your pension savings out from your pot at age 55. Going forward, that's going to change. So by 2046, so if I was born in 1989, that's going to get pushed back 2 years. So if I'm born in 1989 or above, I can't get my pension savings out until I'm 57. The state pension is also going back as well. So currently it's 67, but then it's going to go to 68. And my daughter probably won't be able to get her state pension until she's 70. Reason for that's really simple. Everyone's living longer. There's not enough money in the pot to pay for it. Can you pay more than the minimum? We get asked this quite a lot. So as you saw on the screen earlier on, it's 1% initially and then it moves to 4%, but we've got lots of clients that pay in 10%. All you need to do is notify somebody that's responsible for payroll in your business, and they will deduct that from your pay for you. Where do you get the opt-out notices from? You have to personally email the Carey Pensions team to request the opt-out notice. Nobody at your work can do that for you. So many thanks for watching this video. Hopefully it's given you a little bit of an insight into workplace pensions, how it's going to affect you and how much it's going to cost you. Please, if you've got any questions, the contact number or the email address is coming up on the screen behind you.